Hi everyone, thanks for tuning into my channel, All Things Accounting. Today, what I'm going to walk you through is the double declining balance method. So stay tuned and we'll get through this together. So, the double declining balance method. Normally, when would it be useful? For example, we have here tablets and laptops, especially cell phones, very technologically advanced items. Sometimes as soon as you buy things like this, it tends to become obsolete or appears to be obsolete because something else newer and better always comes by very, very soon. So sometimes we'll be inclined to use this up very, very fast. So if we're going to be doing it that way, it sometimes might be useful to recognize the expenses, a lot more expenses, double of what the declining balance method, hence this name is double declining balance method. So the benefit of this would be it provides a higher tax write-off during the earlier life of the asset. For example, another example would be the usage of a vehicle for employment purposes. If a business uses a vehicle a lot, then at the beginning of the estimated useful life of the vehicle, you'll be using the double declining balance method to recognize more expenses on the books as a write-off and less in the terms of maintenance costs. Whereas at the end of or nearing the end of the estimated useful life, it's reversed. You'll be recognizing less of depreciation, but more of the cost by way of maintenance costs. So there's tax implications for it too. So I want to take you through a numerical computation, just a quick example. So let's go to the whiteboard. Follow me. So the depreciation under double declining balance method, it'll be recognizing much more depreciation at the beginning or in the earlier stages of the useful life of the particular asset. So let's go through a numerical example here. Let's say on April 1st, 2020, we bought an equipment. So if we bought an equipment, and let's say that is $140,000. I'll be using K to denote thousand. And the estimated useful life, is equal to 5 years. Now let's say that the salvage value is going to be estimated to be approximately $20,000. Therefore, we know now based on this that the total depreciation is going to give us 140,000 less 20,000 is equal to 120,000. So when we use the 140 to calculate based on the double declining balance method, our total at the end we want a total of $120,000 of depreciation. So let's go through this. If under 5 years the rate, we calculate the depreciation rate, the rate would be normally under the declining balance or the straight line would be equal to 1/5, which is 0.2 or 20%. Now, if we were to calculate under the double declining balance method, we multiply that by 2. So that would yield 40% rate that we're going to have to be working with. So let's say that on April 1st, okay, that's when we bought it. So in 2020, our depreciation is going to be 140,000 multiplied by 0.4 for the 40%, multiplied by 9 months out of the 12 months out of the year, because it's on April 1st. So we're going to be counting from April 1st all the way to December 31st. Okay? So if that's the case, that will be yielding $42,000. Okay? 42,000. Remember, this is what we call proration. So we're prorating the depreciation based on not a full year's worth of depreciation taken. In 2021, our depreciation is going to be then 140 minus the 42,000 that was recognized in 2020. So 140K minus the 42K multiplied by 0.4 for the double declining balance rate, multiplied by 1 whole year, or 12 out of 12. So that's going to yield $39,000. So our total depreciation for these 2 years is going to be 81,000. Sorry, here, 200. So 81,200. That's our total depreciation recognized for both the sum of 2020 and 2021. In 2022, the way we would calculate depreciation here would be 140K minus the 42K minus the 39,200 that was recognized in here in the second year, multiplied by the double declining balance rate of 40%, and we could multiply by 1, or 12 out of 12. So we could multiply by 1 in this case for 1 full year. So that would give us 23,520. Now, if we were to add these two up, that would give us a total of $104,720 for total depreciation expense. Let's continue on. In 2023, how we're going to calculate this? Well, it's the original 140 minus the 42 minus the 39,200 minus the 23,520 multiplied by 0.4 multiplied by 1 full year. So that will give us 14,112. Now, if we add these together, that would give us $118,832 for total depreciation as at the end of 2023. Now remember, take into account that we have to reach up to $120,000 of depreciation. Therefore, in 2024, we could easily calculate this to be 120,000 less than 118,832, and that would give us $1,168 that we would have to recognize in order to bring us up. This plus this would give us the total of 120. Let's say that we calculated originally that for the 2024 year as how we did on all these steps. What would that give us? Okay, so let's just put that aside. So let's say that if we skip down here, 2024, if we were to calculate that at 140 minus 42K minus 39,200 minus 23,520 minus 14,112, and then multiply the whole thing by 0.4 multiplied by 1 full year. That would give us a number that would be still larger than this, but we only need to recognize up to $1,168 in order to bring us up to $120,000 in total for the total depreciation expense under the double declining balance method. So I hope this makes sense. Again, just going through it, you can notice that the total depreciation for each year, 42,000, then it drops to 39,200, then it drops to 23, then 14. So you have a benefit in the earlier life of the fixed asset in terms of a higher write-off, which helps to reduce your net income for tax payment purposes. So it has tax implication and tax benefits there. So I hope this helps. Please remember to subscribe to my channel. Click that like button and hit that bell notification icon so you're always up to date on the new tutorials that I have to post. Until next time, take care.